We've seen a wave of positive developments in trade negotiations over the past few days. It started with the UK, where both parties reached a new agreement. Then, over the weekend, US and Chinese representatives met in Geneva for the first round of trade talks. On Sunday, both countries jointly announced that the meeting was constructive and productive. As of May 12th, the US has agreed to lower tariffs on Chinese goods from 145% down to 30% for 90 days. China will reduce tariffs on US goods to just 10% and remove certain trade barriers. Let's take a look at this CNBC clip featuring US Treasury Secretary Scott Bessent. And I will explain why I believe we are seeing the early signs of the next bull market.
After this weekend, we have a mechanism for continued talks. So, process, plan, and mechanism. I would say one of the big takeaways from this weekend, the United States will continue, whether it's medicines, whether it's semiconductors, steel, we've identified 5 or 6 strategic industries and supply chain vulnerabilities, and we will continue moving toward U.S. independence or reliable supplies from allies on those. But the consensus from both delegations this weekend is neither side wants a decoupling. And what had occurred with these very high tariffs, as Ambassador Greer said, was the equivalent of an embargo, and neither side wants that. We do want trade. We want more balanced trade, and I think that both sides are committed to achieving that. We would like to see China open to more U.S. goods. We expect that as the negotiations proceed, that there will also be a possibility of purchase agreements to pull what is our largest bilateral trade deficit into balance.
As you heard, neither side wants a decoupling, and large purchasing agreements are likely on the way. This sets an important tune for the future of trade relations between the world's 2 largest economies. I believe the US, China, and other countries will soon strike trade deals that benefit all sides. This could break the current holding pattern and kick off a new bull market. Here's why. The aggressive tariffs had reached levels so high they practically halted trade between the US and China, except for certain computers and electronics. These exceptions highlight how damaging the tariffs have been, especially for the US. The administration clearly didn't want to cut off supply chains essential for advanced technologies, defense, and AI development. Both sides have felt significant economic pain in a very short time, creating strong incentives to resolve disputes quickly. In China, much of the export manufacturing has come to a stop, affecting millions of jobs. Meanwhile, US e-commerce giants like Amazon and Temu have raised prices on essential goods by 25% to over 100%, directly hurting American consumers. On top of that, retailers are now warning about potential product shortages in the coming weeks. President Trump's recent meeting with retail CEOs from Walmart, Target highlights just how seriously the administration is taking the economic impact of tariffs. It's also a signal that Trump doesn't want to harm the US economy even a day longer than necessary. While many have criticized the tariff strategy, I contrarily think it's brilliant. In my last video analyzing the tariff outcomes, I outlined what's now becoming even clearer. Trump's tariff policy serves 3 key strategic objectives. First, it's a negotiation tactic to bring trade partners to the table while watching how they respond, seeing who blinks and who doesn't. Second, it's a fast but painful experiment. Yes, an experiment to understand worst-case scenarios for the US and its key trading partners. Third, it helps identify the strengths and weaknesses of both sides, which in turn shapes more effective negotiation strategies to strike better deals and ultimately reduce US fiscal deficits. This approach only works if the tariff shock is forceful and impactful enough, and I believe that objective has been achieved. So what's next? With phase 1 of the trade war gathering critical data now complete, the administration has purposely chosen to strike near-term deals with both its easiest and toughest trade partners, the UK and China. This creates a baseline and framework for negotiation with other countries. The move also sets a powerful example for key partners like Canada, Mexico, and the EU to fast-track their own negotiations. At this point, further escalation doesn't seem wise. If the world's two largest superpowers can resolve differences quickly, pressure will build on other countries to follow suit. We are now entering phase 2 of the trade war, widespread constructive negotiations. As investors, we should expect the market not only to stabilize, but to begin looking ahead to 2026 and beyond. A new bull market could be forming, driven by 5 powerful tailwinds. Trillions in committed investment from domestic and international firms in the US strategic manufacturing. Large trade deals that benefit both the US and global economies. A restart of the low interest rate cycle. Extended tax cuts and pro-business deregulation. Most importantly, progress toward reducing the US fiscal deficit, laying the foundation for long-term prosperity. Since the beginning of the tariff uncertainty, I've stayed bullish and been buying the dips. If you've been following my analysis and doing the same, congratulations. If you're new to the channel, make sure to subscribe so you don't miss the next wave of opportunity. I'm confident there will be plenty more to come. Also, follow my posts to stay updated, especially when I start buying again, as the market right now is looking overbought. Thank you and see you soon.